Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, the regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me is Chuck Fuller, Portfolio Manager at Nasdaq Dorsey Wright, Sara Marshall, Senior Index Research Strategist at Nasdaq Global Indexes, and Cary Carbonaro, Managing Wealth Advisor at Ashton Thomas Private Wealth. We're here to discuss asset class rankings, sector performance, and why investing based on a political party is not always the best strategy. It is great to have all of you back with us. Welcome to Trade Talks, and let's kick it off, Cary, with that theme around not investing solely based on what political party has won an election. It's very fresh in our minds right now. Tell us about some of the trends that you've noticed there.
Yes. So all my clients, depending on which party they're at, they're either thrilled or they want to go to 100% cash. And so I have been counseling all my clients, especially the ones on the Democratic side, that is absolutely not the strategy to do. And I'm using this fantastic slide that shows over the past 75 years, if you invested just on a single political party, either just investing when Republicans win or just investing when Democrats win, you over a dollar would be like $100 or less. But if you invested under both parties, you'd have $3,200. So, I mean, the stats are staggering. So it doesn't matter. I always say it doesn't matter who gets in, but it's very interesting to see how clients react to who is the president and which political party.
Yeah, and that's a great point that you make. And we've seen this in charts time and time again when it comes to market timing and how it's essentially, it's an impossible task, right? It reminds me of Sisyphus, or you're trying to, constantly get that rock up the hill. And Chuck, we saw the reaction that the S&P 500 had once we removed that piece of uncertainty out of the market, right? We knew there was a concession. We knew that we were going to move along. Yes, policy is still up in the air. Yes, the 100 days haven't happened yet in Trump's, first, error within his new administration. But if you take a look at U.S. equities, S&P hitting over 6,000 for the first time since the election, it's still number one in terms of asset class rankings, equities.
Yeah, it is. That hasn't changed. That's been the case for a long time. So, even with Trump getting in, like I said, half the country thinks it's a terrible, terrible thing, but markets, so far don't seem to be thinking the same. The S&P hits 6,000, and we've gotten a pullback since, a little bit, but I would argue that that's kind of a textbook pullback. The market's got a bit ahead of themselves, post-election, and I would say, a textbook pullback would probably take the market down to around 57.50, and that'd be totally fine. Another thing I'll bring up, as it relates to the election too, kind of going off of what Cary was talking about, is the last time that Trump got in, you would have thought that there would have been higher volatility in the market. But in 2017, which was really the first full year of his first presidency, it's one of the lowest volatility years in history. So it just kind of goes to show that just because you think something has to happen doesn't mean that it necessarily will.
Yeah, that's a good point that you make. And Sara, we see that reflective in the Nasdaq 100 as well. Relatively same kind of pattern with these normal pullbacks, but still within that buy trend.
Exactly. So similar to what Chuck mentioned with the S&P 500, the Nasdaq 100 hit an all-time high at 21,000 on November 7th, and has since pulled back to 20,400, which, as Chuck said, completely normal pullback. We're at about 32% overbought here. The chart remains on 3 consecutive buy signals and well above that positive trend. Similarly, the Nasdaq Composite, I just looked at that chart, that pulled back as well after hitting an all-time high, but has since reversed up and actually added a few X's today. So the Nasdaq Composite up almost about 5% this month, while the Nasdaq 100 is up about 4%.
Yeah. And Cary, for the ones that remain invested, is everyone still overweighted to large caps, or are they starting to nibble in other areas of the market, in the small and mid space?
Yes. Well, it's so interesting because if you really look at anybody's portfolio right now, if they didn't do any rebalancing, everyone is overweighted in large cap. And definitely underweighted in small cap because it was doing so poorly for so long, or out of favor. And then the day after the election, it had its biggest one day up over almost 6% in one day. So we are reallocating into the asset classes that have been out of favor: small, mid, REITs, international bonds. We're international small cap. We're really trying to diversify out of large cap into everything else.
Yeah. And Chuck, from the asset class ranking perspective, what are you seeing in terms of asset classes and sectors, as well as that relatively reflective to what Cary's, how Cary's clients are allocated?
Yeah. So I mean, it's been interesting. Yeah, that move in small cap was something, right? The day of the election. It was kind of interesting too. We had noticed that, it wasn't a kind of a broad small cap push like you might have expected. I feel like usually when you see a big day in small cap, usually it's, a lot of the small caps are all going up at once. But it seemed to be more of the larger small cap names were getting most of the bid, which was kind of interesting. So it really didn't help breadth as much. Now, I'll say breadth has been good really for the past, I'd say maybe 3 months or so. It's been very good. So we don't have any real worries there. But it is something to keep an eye on. In terms of, the style caps though in our rankings, like large cap growth is still number one. It has a large lead over number two. If this selection is, kind of time for a change in that, it's going to take some time for our rankings to change to reflect that. But so we'll have to see how that goes. But in terms of sectors, I mean, really not much has changed over the last month, which is always interesting. You get one of these big, kind of volatility events like an election or what have you. You expect to see a lot of changes, but we really haven't. I mean, financials are still at number one. Industrials are at number two, technology at number three. And even though, we saw some big sector moves over the past month, really around the election, things like, energy was up 6%, comm services was up over 5%. So some big moves, even though the market wasn't, up that big, let's say over the last month. But it really hasn't changed much in terms of our rankings yet.
Yeah. And Sara, what are you seeing from the index perspective as it relates to themes?
From a thematic index perspective, we've seen strength, particularly in the KBW Nasdaq Financial Technology Index this month, up almost 14%. Also some strength, not too far behind, is the Nasdaq CTA Global Video Games and Esports Index, which tracks obviously the video and esports sector, but also strength in emerging cloud, digital payments, and cloud computing. Really seeing weakness in biotech and semis. And then in our sector-specific indexes, really strength across the banking sector. So the KBW Regional Banking Index up over 10%. And then outside of traditional sectors or even asset classes, we've seen a pretty significant pop in our crypto indexes as well.
Yeah, we certainly have. And Cary, when you think about the economy going into 2025, for all intents and purposes, unemployment, the situation looks good there. The consumer continues to spend. Of course, taxes and what happens within Fed monetary policy, that's always going to be an outlier, right? So, with those removed from the scenario, the economy is still in a pretty decent place as we look into 2025.
It is. It's very strong. I believe that Trump is going to put in policies that are business friendly, and he's definitely going to make some tax cuts. Unfortunately, I don't think he can make every single tax cut that he's promised, because he wants to bring corporate tax rates down to 15%, which is great for business. But he also wants to give no taxes on tips, and he wants to remove a lot of for lower to middle class people. He wants to give them the tax breaks as well. So it's going to be interesting because it's an expensive proposal, everything that he's put out there, but I believe the tax cuts are on the horizon. I just don't know where and when, how fast, and who's getting them. So, and that's kind of hard for a planning perspective, because we're trying to plan for 2025. But yes, overall, the economy looks good and tax cuts coming.
Yeah, and that's kind of what the challenge is. I would say even more so the monetary policy, but fiscal policy. I mean, the trajectory that we're on is clearly unsustainable, but it's a tough political position to put yourself in, whether you're raising taxes or you're cutting spending, right? Or if you continue to increase spending, it's not going to make everyone happy, which of course we know is impossible. But I think, in my mind, what happens with tariffs and what happens in terms of fiscal policy, that's really going to be the outlier for 2025. In those first 100 days, hopefully we'll get some more clarity there. I mean, you have to think about it too from the corporate perspective in terms of being able to, plan your fiscal year and what your forecasts look like. So, it probably won't have much impact to this quarter, but perhaps for reporting for the following quarter, that guidance might be a little bit more challenging to introduce.
Well, what's interesting to me on the tariff side is, all the economists say that it's going to, increase inflation. And the last thing that Trump wants to do is increase inflation. And if it's so interesting, because if you go back in history, when we first started as a nation, as the United States, George Washington, when he was president, there was no taxes. It was only tariffs. And so just to me, that's incredible that that's where we actually started in this country, was no taxes and tariffs. So it's going to be a balancing act. I'm sure he's going to do whatever he can to not increase inflation, but he definitely wants to add tariffs. So we'll see what happens and see if that can lower our taxes at the same time.
Yeah. So Chuck, I really, it always kind of comes back to what the market is pricing in and what the price action has confirmed. So when you think about technical levels as we look ahead, do you continue to see that upward momentum in place? What are some of the key levels that you're going to be looking at as we head into the last month of the year already?
Yeah, I mean, I think that we don't see any indication that the technical levels are anywhere close to faltering. If I look at the S&P 500, obviously it hit 6,000. It's pulled back here on our chart, but really hasn't even pulled back into what we call a column of O's, which would indicate some short-term weakness. Probably the first sign on the S&P that you would, maybe this turns into something bigger would be around 5650. That would be the first sell signal on the chart. But really being at all-time highs, I mean, it's, the price objective on our chart, which is kind of like a target, is 6,700 right now. So that's, there's definitely still some upside we feel in the market.
All right. Appreciate everyone's insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.